Hey folks, welcome to Lead an Indicator, a show by Public.com focused on gaining insight from the world's very best macro minds. I'm your host today, JD Durkin. We are with you today to discuss the weakening of China's economy and whether or not the world's second largest economy is on the brink of a so-called Lehman Moment. As always, don't forget to like, comment, and subscribe to our YouTube channel for more in-depth interviews to help keep your portfolio on track and to keep you up to date with the latest investment news. Today, we are joined by Shehzad Qazi, Managing Director at China Beige Book. Shehzad, welcome to Public. Nice to have you here.
Thanks for having me back.
So, of course, obviously, a lot of concerning headlines, even for people here in the U.S., about the state of China's economy, deflation, a property crisis, record youth unemployment, declining industrial profits. And as you know, Shehzad, this just names a few of the challenges. How troubling from where you sit do you think the current economic situation is in China, and how much worse might it get?
Look, there's little doubt that the Chinese economic recovery for 2023 has been vastly below expectations. But there are a couple of things going on here, JD. The first thing is that expectations for the year were wildly unrealistic. The idea that you were going to see this all out spending boom by the consumers and the manufacturing economy doing really well and property all of a sudden magically transforming, this was just some pie in the sky stuff being written about by the banks on Wall Street and investment bank research teams. It was completely wrong. It was never going to be the case. That said, yes, of course, you have a much slower and weaker recovery that is taking place. And there are parts of the economy that are doing well, but the entire story, of course, is being overshadowed by the fact that the property market is in very serious trouble and the risk of larger financial problems is giving markets a lot of anxiety right now.
I want to touch on Beijing's efforts to try and boost markets. We did have a shortly lived stimulus rally on Monday. It followed several newly announced stimulus efforts by authorities. But what should we make about that particular component of the equation right now, as efforts are ongoing by Beijing to try and boost some of those markets?
One of our key messages for the year, and in several instances in the previous years as well to markets, has been do not bet on big bang stimulus. The idea that China is going to just stimulate its way out of this slowdown that it's currently in, the way it did in the post global financial crisis era, is incredibly misleading and again, very, very incorrect. That growth model that depended on ramping up a whole lot of debt to get a whole lot of investment in the economy and to juice big growth numbers, that economic playbook is done. It's out the window. The playbook that Xi Jinping on downward today in China that you're seeing is one that is more focused on acknowledging a slower pace of growth and accepting it and hoping to transform the economy to something that's much more sustainable, which means de-risking the system, which means deleveraging the system. So what you're going to continue to see is moderated stimulus, targeted stimulus, as you've seen so far, and markets will need to massively readjust their expectations to this new scenario rather than expecting trillions and trillions of yuan just being dumped into the economy.
Shazad, why do you think investors so far seem to be so underwhelmed?
Well, I think the perception of the market in terms of how China continues to manage its economy is very dated. Markets and investors largely, I think, have not figured out as yet that the Communist Party in China, Xi Jinping, onwards down again, as I said, they are no longer interested in posting these big growth numbers. They're not interested in propping up, the real estate market so that you have buildings upon buildings being built and highways to nowhere being constructed again. Investors, the average investor, continues to think of China in very much a post 2010 lens rather than a post 2020 lens. That's a very big shift that needs to happen. And a lot of investors have failed to make that happen, and they're losing money, quite frankly, because of it.
Do you think we can expect to see a more aggressive stimulus package in the near future?
I don't think so. I think what you get is, on as far as the fiscal side is concerned, again, very limited announcements on fiscal projects. You will see some of that continuing to happen. You've already seen some amounts of transportation, a little bit, some of the projects within the pipeline. Speaking of monetary stimulus, this is very, very critical here. We have seen monetary stimulus in plain sight all year long in China. If you look at the China Beige Book interest rates data, it has been falling since the beginning of the year. The problem in China right now isn't that there isn't sufficient amount of monetary support or credit supply isn't there. The problem all along has been that companies are not yet convinced that the economy is in a place where they should be ramping up borrowing, ramping up investment, and ramping up hiring. It is the credit appetite among companies that has been the biggest stumbling block in terms of revving up the economy. So this is how I would suggest that all investors think about this is a framework that you need to work within for the year and for next year.
Of course, we talk about the US and China being the globe's two largest economies, but there are fundamentally different ideologies that could be politically, could be geopolitically between the two nations. And I wonder, what should our viewers know in terms of the impact of ideology on economic policy in this conversation?
Yeah, that's critical. I think the current leadership in China has made absolutely clear that whereas they don't want a stock market rout, of course, that they're not there looking to have big gains in the market. They're not focused on, the valuations of their major tech companies or the equity prices of those companies. They are much more focused on large scale social and economic transformation. And of course, making sure that the big companies that we have in China, the big tech companies specifically, are all ultimately working toward empowering the state and really by extension the Communist Party. This is a very different model that which we were accustomed to when we used to think about China in the last 20 years, reforming and reopening and more privatization, more liberalization of the economy. We're actually taking a few steps away from that now. So ideology is going to be very, very important. I think in both countries, national security, it's become the most popular and perhaps overused term, but national security now is dominating a lot of the thinking towards economic policy. I would say on the China side, they've done it much more effectively, given the different systems they have over there. We're slowly figuring out how to incorporate national security concerns into our trade policy, into industrial policy, and so forth. But again, very ascendant, something that investors have to start paying serious amounts of attention to.
One quick follow up on this. Could you talk to me a bit more about China's Communist Party? Because that's a phrase I think, if you listen to politics, you hear Democrats and Republicans, that is how they define it, right? It almost seems as if here in the US, some people may go out of their way to sort of remind domestic investors of that political reality. What are some of those more characteristics of those traits of the Chinese Communist Party that you think are important for this conversation?
Yeah, I think the Chinese Communist Party, the CCP, has changed quite dramatically under Secretary Xi, and one of the key characteristics again now that investors should understand is that Secretary Xi, President Xi, whatever you want to call him, is very much focused on making sure that companies and businesses exist to empower the state and empower the party by extension, and not the other way around. He does not want a system in place where the top CEOs of major companies all of a sudden decide that they have a position in deciding the future of the country, that they have a place to say this is what regulatory policy needs to be. Absolutely not. The party will decide what the regulatory policy needs to be. The party will decide the appropriate place for where these companies fit into the larger social fabric of Chinese society. And that is a very different outcome, right? Because that means more unforeseen tech regulation probably coming down the road, new challenges emerging, laws such as the data security law, the counter espionage laws, things that investors completely did not expect. No China watcher was on the lookout for this, emerging and catching you by surprise and having very serious impact, maybe oftentimes devastating, some of the valuations of these companies and the market capitalization of these companies. So that's how I would urge investors to think about. Start taking politics and geopolitics very, very seriously. And it's all connected, domestic and the geopolitical environment here.
I mean, I can't help but ask. I don't know how much you're willing to weigh in on this. I mean, many have said when China, and even Elon Musk has said this before, when China talks about Taiwan, you have to take China seriously. Is that your stance as well? That whether you perceive these as threats or whatever, I mean, this is an incredibly important market conversation in terms of China's positioning on Taiwan. Are you also of the thinking, as Elon Musk and many members of Congress are, to say, hey, when China makes these threats or China says certain things, you have to take them at face value?
Absolutely. I think there's no looking away from the fact that the current leadership in Beijing is very serious about reunification. Now, here's where the challenge comes in for markets. It's impossible right now to forecast when that's going to happen. And lots of indicators people look at, movement of ships and all of that. at the end of the day, given the change in the Communist Party with Secretary Xi being as ascendant and powerful as he is today, this decision will likely be made almost exclusively by him. And trying to get into his head is not a good idea, which again means having to have a very sophisticated way of keeping on top of developments that could raise the probability of a Taiwan invasion or perhaps bring them down. But we have to absolutely take China seriously about this, and we have to become very sophisticated in how we go about tracking this, because we won't know the exact moment this event happens, but being prepared for it and knowing the right indicators could be the difference maker between getting absolutely washed or still coming out on top.
And we know China's currently watching the largest land war in Europe since 1945 play itself out between Russia and Ukraine. And this is a story in terms of markets that implicates far more names than just simply Taiwan Semiconductor, although that is certainly a giant in the space. Okay, let's pivot now and focus on real estate markets. It accounts for about 25% of China's GDP, experiencing a lot of turbulence. We've seen the headlines recently with Evergrande, Country Garden, mountains of debt. Some of these names are really struggling with coinciding here at the same time with declining consumer confidence. How did we get here? What is the latest for the property crisis for people that have seen the headlines and need to make heads or tails of it?
Yeah. Point number one, related to my earlier comment, there is a very serious desire to de-risk, to deleverage the system. And deflating the property bubble was the critical central piece of that. Keep in mind that this is something that China technically did to themselves. But the best part of the smart thing about this policy, quite frankly, was that they opted to deflate the bubble on their own timing and on their own terms rather than deal with a hard landing and actual crash and then have to respond to the problem. So that's rule number one that we need to keep in mind. Deleveraging, de-risking is very important right now in China. Number two, the property market is in a multi-year restructuring phase, and expect the next several years to be, I think, filled with stories of developers looking like they might default, developers, some smaller developers that might go under, in the future, and larger concerns around what that means for financial contagion, and things like this Lehman Moment conversation, or some variety of it coming up. So be on the lookout for that. Number three, what are we actually dealing with? We're dealing with a property sector that is, the values of properties that certainly have come down pretty significantly over the last several years. You still have a lot of inventory that's sitting out there that the sellers are having a hard time getting rid of. But at the same time now, what you have is very, very weak consumer sentiment, right? Households who've had their wealth already destroyed are certainly not looking to double down on the market. And new entrants are sitting back and watching the market, seeing if prices will go lower, because nobody is convinced that the property market in China has found a floor. All that said, if I can pull back, and happy to come back and discuss this in more detail, does this mean that we're looking at a Lehman moment in China? No. A Lehman moment cannot take place in a non-commercial financial system. We had a Lehman moment because it's a commercial financial system. The government can't just tell banks what to do. We had to plead the banks to step in, ultimately take over as the collapse got worse. In China, the financial system is controlled by the state. The biggest banks and even the provincial banks, the rural banks, the vast majority of the banking system is state controlled, which gives the party the ability to step in, take over projects, fund projects, and take over companies, et cetera, et cetera, et cetera. There's a whole different conversation to be had about that, about creating moral hazard and throwing good money behind bad and all the rest. But that said, do not buy into this idea that you're about to hit a Lehman moment in China. It's quite frankly not possible. And as we saw in the aftermath of Evergrande, the government does step in. It's not going to step in to bail out the billionaires of the Evergrandes and the country and the owners, but they will step in to protect the system from larger collapse or degradation.
Well, it's almost as if you knew what my next question was going to be, but you did get ahead of it and you answered it correctly, or at least earnestly. So I do appreciate your context there on that, Lehman, because people will see those headlines. And I think that context is really important. So speaking of context, give me a bit in terms of how significant you think China's trade is for the global economy, why the economic slowdown matters in terms of global investors. What are you following on the trade front?
Yeah, Chinese trade is incredibly important, whether you're a commodities producing a country in Latin America, or you're in Australia, or You are a developed economy like Japan or Germany that exports a lot of machinery or input goods to China. So the Chinese slowdown is going to absolutely have ramifications. It's going to have the biggest ramifications, as I said, to countries that export commodities, iron ore, copper, and of course, there's a whole conversation to be had about oil. It's a little bit different than the regular commodity cycle as it relates to Chinese demand. It's going to have an impact on the German economy. It's going to have an impact on the South Korean, Japanese economy. So a China slowdown most certainly is bad news, for the global markets. But I think again, let's take a step back and also focus on the fact that Western demand is already slowing down. China is already starting to face some headwinds vis-a-vis slowing exports to these countries. So it's much, it's a lot more nuanced, that conversation. But the fact is that, look, second half of this year, Chinese manufacturing probably will continue to stall, slow a little bit. And so going into 2024, we're not looking at an incredibly bright global growth picture.
The U.S. Commerce Secretary Gina Raimondo is meeting with Chinese officials today. Trade relations in the U.S. front and center. How would you describe the relationship between the U.S. and China?
The Biden administration has decided that they want to cool things off a little bit in a positive way, right? So a lot of tensions in the past several years. They want to cool them down. They want to engage with the Chinese counterparts. Um, the issue, I think, will be twofold. First of all, the administration is split between its hawks and doves. So the Commerce Secretary most certainly not a hawk. But what you are seeing within the administration right now is that the doves are ascendant. They've essentially been able to sideline the hawks, and are very. They seem like they're driving policy at this current juncture. You can see it from the executive order. You can see it from the way the export controls have been handled, and now the Commerce Secretary's upcoming trip. Um, I think people within Congress are probably going to be, certain sectors of Congress are going to be, sections of are going to be pretty upset about this. That said, the real question is what exactly are the goalposts? What exactly is being accomplished? Dialogue is always a good idea, especially between two major nuclear powers. But what exactly is the end goal here? That seems to be very, very unclear here. We're not really getting a clear China policy out of the administration almost 4 years in, whether on the more aggressive, assertive side or on the more diplomatic side.
Finally, none of us have a crystal ball, although I certainly wish I did. But I am curious how you see the relationship progressing, especially keeping in mind the fact that, hey, we just had the first Republican debate last week. There may be a new president of the United States come January 2025. What happens then if you have a fundamental different shift in terms of how the administration views this relationship?
I continue to feel pretty comfortable saying that the longer term trajectory of the relationship between the US and China will be one of decoupling, limited decoupling, not all out decoupling, but within sensitive sectors such as technology, such as various supply chains, starting with things like critical minerals and pharmaceuticals, and of course the financial sector. So increasingly, I think whether it's the White House, whoever occupies it, will find it harder to avoid going down this path of decoupling. And I think Congress is already pretty serious about it in terms of being vocal. I think you're going to see more and more action and pieces of legislation over time come out on this. So again, my forecast remains more decoupling rather than trying to walk back the decoupling that has already begun.
Shehzad Qazi is managing director at China Beige Book. Shehzad, I'm very grateful for your context and perspective. Thanks for joining us here at Public today.
Thank you for having me back.